if you've gone to a bank or spoken to a financial advisor about investing in a mutual fund, there's a good chance that you've been offered an option to buy a segregated fund. That is a fund that offers a guarantee when the fund matures or when you pass away. Now, depending on your situation, a seg fund may or may not make sense. And to help us decipher all the considerations is Jason Heath. He's a fee-only financial planner with Objective Financial Partners, and he joins me now. Jason, great to have you on.
Yes, thanks for having me again, Saijal.
So I am really glad to have you explain seg funds because I know so many people who've been offered this. I've been offered it. My parents have been offered it. And on the surface, it seems great because, you know, who doesn't like a guarantee? but I know it's not that straightforward. So maybe explain first what a seg fund is.
So a seg fund, a segregated fund, it's kind of like a mutual fund in that it's a large pool of money that's invested by a bunch of different investors in a bunch of different investments, whether it's stocks, bonds, combination. There are segregated funds that are 100% in stocks. There are segregated funds that are 100% in bonds. There's segregated funds that are a combination of the two. And when an investor invests in a seg fund, whether it's $50, $50,000, $500,000, you own a small proportion of the big pool of assets that's managed by the fund company. I think one difference compared to a standard mutual fund that people are used to is that a segregated fund is structured as an insurance contract. It's issued by an insurance company. So as a result, there are certain guarantees, as you mentioned, benefits, protections, things like that, compared to an investor that owns a mutual fund. And those guarantees typically come into play when, as you mentioned, the fund matures or after a certain period of time or when the investor dies.
Okay, so let's talk about the guarantees because my understanding it is also varies, right? It depends on the type you're buying. Like some are 100% guaranteed, but not necessarily.
Right. Yeah, some contracts will guarantee 75%, some will be 100%. The guarantee is based on your initial contributions minus any withdrawals you've taken. So it's a principal guarantee, which sounds good. I always tell people when it comes to financial products, when you hear guarantee, that usually means expensive. And I think that's really important. The guarantee typically applies after 10 years or upon death. And over a 10-year period, it's very unlikely for a diversified portfolio of investments to have a negative rate of return. So even a 100% guarantee, let alone a 75% guarantee, may not be that valuable after all.
Yeah, so let's talk about that because in your experience, does that guarantee really even make sense? I always say, well, like, why wouldn't you just buy a low risk, diversified, blue chip fund that over 10 years will likely go up? And if you really want that guarantee, you buy maybe a GIC. Wouldn't that make more sense?
I think so. I think a diversified portfolio is probably going to give you a better outcome. I can't say for certain, but I suspect that in nearly all 10-year periods that you could pick, you'd come out better off in a diversified portfolio of investments, in large part because of the fees that are involved with seg funds.
Yeah. So what are the fees? Usually a typical mutual fund is about 2% MER.
Yep.
Compared to that, what does a seg fund charge?
So seg fund fees tend to be about 1% higher than a typical mutual fund. As you mentioned, in Canada, the average fund fee is about 2% for a mutual fund. So seg funds are typically in the 3% range, which is pretty expensive regardless of how you invest your money. But I think often the people who gravitate toward guarantees are more conservative investors. And I think that's what can make seg funds even less appropriate or more challenging, because if you're paying 3% in fees and you're in a conservative portfolio where the bond portion's earning 3%, you're paying 3%. 3 minus 3 is 0. So you might have a good portion of your money that's just going sideways.
Yeah. We have about 45 seconds until the break. You mentioned there is a period that you would be locked in for. Does that vary? And if you do sell beforehand, is there a penalty?
Well, sometimes mutual funds or segregated funds can have deferred sales charges where there is a penalty to get out. you may be foregoing the guarantee, but again, the guarantee may not matter. Your principal, particularly, given how markets have performed in recent years, will probably be, well protected and then some.